Okay, hello everybody. Uh, Welcome back again. Before we start, just do a sound check. Is everybody can hear me okay? Can all of you hear me? Just say yes or no. Let me just check. Okay. Okay. Okay, hello everybody. Okay, a lot of people here today. Now, I hope you guys will participate in these questions, whatever questions I ask. Okay, there's a question that where am I from? I'm from Malaysia. Okay, I'm from Malaysia, residing in Malaysia, and I go all over to teach as well, a few countries. Okay, all right, let's start today. Yesterday we did some business valuation, corporate restructuring, and also what do you call this? Mergers and takeovers using the consideration of various methods of consideration. Today, what we're going to do is we're going to still go on a little bit on valuations as well as takeovers and all that. Okay, so we're going to do a question called pursuit today. We might not go in full, but we're just going to go to approach on how to attack a first question, question number one. Okay. Oh, there's a question here. Let me just answer this question. Maybe some of them are still coming in. There's a question here saying that 6%, it is correct to use 6% interest to calculate IRR for bond for negative PE, it's just 5%. Yeah, you can use any discount rates you want to calculate, but preferably one positive and one negative NPV. Okay, Alexei? Yeah, that's what you should get. Okay. All right, let's start. Let's start today. Let's get out. I'm afraid I can't finish this one. We'll keep the questions coming. We'll answer as and when the need arises. Okay, now, let's make it smaller. Okay. Pursuit company, if you notice this question, this is going to be a Q1 style if you ask me in today's terms. Now, the approach for question one, I would do this. Now, in exam, I would always do this. I would always go for section B first. Okay, I would always do section B first. And I'll go and now you only have two questions in section B. I mean, there's no more section B. There's only question 2 and question 3 now. Question 2 and question 3, where you have to answer 25 marks, 25 marks. Get this 25 marks in 45 minutes and 45 minutes. I still have 1.5 hours for question 1. So in that 1.5 hours, the last 1.5 hours, what I'm going to do is I'll write up all my appendix first. I'll write up all my appendix. Plan yourself 45 minutes to 1 hour, all your appendix. Like in this question, what goes to the appendix will be, in this case, it's a report. Okay, it's going to be a report writing. This is going to be evaluate whether the acquisition of further. This is going to go to my appendix. Is that okay? Include all relevant calculations. All this is going to go to the appendix, 25 marks there. This will go to my report. This again goes to my appendix. Okay, then the rest all goes to the report. Okay, so this all goes to the report. Okay, I would not finish this report because it's going to, I would like to do new questions. Okay, I just want to show you how to go about doing question 1, this part of this question, especially when you have these takeovers. And also limitations, as I've said yesterday, limitations. Okay, what are the limitations of a takeover, etc. Now, here it says here, prepare a report that evaluates the acquisition of further, whether it will be beneficial for Pursuit and its shareholder or not. Now, this is a common type of question. Will it benefit or not? Well, it will benefit if I say my value is worth 5 million, your value is worth 2 million, combined we're going to have 7 million. If I'm going to pay you, say, sorry, combined value, let's say it's 10 million, okay? So 5 plus 2 happen to be 10. So will it benefit to Pursuit or not? It depends. If I'm going to pay you 5, then it doesn't benefit me at all. But if I'm going to pay you 4, then of course it will benefit me with 1 million synergy that I'm going to take. That's how we're going to see this question. Whether will it benefit to Pursuit company and its shareholders, the free cash flows to the firm again. Examiner is very clear. Our examiner is very clear on the firm or equity. But some questions, there's 1 or 2 questions, you can do both. There are 1 or 2 questions. Can't recall offhand here. You can do both. In that instance, I believe they would mark both correct. Yeah, I strongly believe they would give both correct. Yeah. Used to estimate the value of folder and combined company, assuming the combined company's capital structure stays the same as that of Pursuit. Current capital structure, include all relevant calculations, limitation. I tell you what, we come back to this all later as time permits, okay? Because I always go very slow. I don't want to rush into everything. So I believe that this too is an important area onto your syllabus. Maybe you can add this one as well, important area on your syllabus. So maybe today I'm just going to answer 1, 2, 3, and I show you how a report is being carried out for this one. Okay, now let's start. It's going to be a big question, so we're going to put some paragraph numbers just in case you want to refer back. Now, Pursuit is the listed company again. There won't be a problem in valuation for Pursuit because Pursuit is already a listed company, which is manufacturing in electrical components and all that. So always look at the type of the business, see whether synergies can be found or not. I'm just fast forward a bit. Okay, they're doing some sophisticated electronic products. The owners of Folder now, the Folder are a consortium of private equity investors who have been looking for a suitable buyer for their company for some time. Pursuit company estimates that a payment of the equity, so this is a key thing here, Pursuit feels that he pay Folder whatever the value of equity for Folder plus on top of that. Now this is a must. When you take over companies, you don't give them market price. You must pay them more because you are acquiring control. Is that okay? You're acquiring control, then you have to pay a little bit more. Market today is about 20 to 30%. Is that okay? 20 to 30% as the time I speak today now. I think it's 20 to 30% should be fair. So this is sufficient to secure the purchase of Folder. Pursuit would also pay off outstanding debt that Folder owed. Pursuit wishes to acquire Folder using combination of debt finance and cash reserve, 20 million, such that the capital structure of the combined company remains at Pursuit company's capital structure. So what are they saying here is that they're going to pay equals to cash. This is not a share for share exchange. They are just going to use debt finance plus whatever reserve they have. Debt finance is they're going to borrow money and they're going to take the cash and they're going to pay off the Folder shareholders. That means there won't be any increase in shares in Pursuit companies shareholdings, such that the capital structure of the combined company remains same with Pursuit current capital structure. So the first paragraph, I think the important thing that would like to note here is that this is going to be 25% premium on top of the equity value. The question now is, what is the equity value method? Well, I think we saw in part A, it's going to be estimated using free cash flow to the firm. Yeah, free cash flow to the firm is going to be used as the equity value for Folder. Pursuit shouldn't be a problem because it's listed. That was paragraph number 1. Now, second paragraph. Now we're going to Pursuit company and further company details. Now they give you market debt equity. Market debt equity, this is going to be a ratio of 1:1, 50-50 in percentage. They've given you a proportion, half. Equity beta, of course, they are listed. They have a readily available beta. Currently, Pursuit has got a total firm value. Now, firm value is value of a geared company. Is that okay? Value of a company that is includes value of debt as well as value of equity, which is going to be 140 million. Now, if you want to break it up, or you can use 50-50, or you can simply use 70-70 is fine, not an issue at all. So I think Pursuit's value is given. So we want to know whether it's worth or not. Remember I said 5 plus 2 equals to 10. How much you're going to pay, and then we're going to see whether it will be benefit to us or not. So we already know this is 140 million. So I can put it here if you want to. This is 140 million. I need to find out how much I'm going to pay and what I'm going to get. Okay, if I'm going to pay 40 and I'm going to get 200, then it's worth it. If I'm going to pay you 40 and I'm going to get 180, then it is not worth it. That's how we're going to approach this question on the premium. Premium part. Will it benefit the Pursuit shareholder? Okay, the third paragraph is for us to they've given you the data here for this particular years here. This is the income statement extract. Okay, now this is the actual question. Now, what comes to your mind? What comes to your mind here? Is this a forecast or is it the past? What comes to your mind? They said here, year ended. This is 2008, 2009, 2010, 2011. What comes to your mind? Is it? You can type it out now. Is it past or is it the forecast for the future? Sales revenue, they give you operating profit, cost, and taxable. Now, this operating profit is after TAD, after all other expenses. So this is after TAD. So your job will be just to add back TAD. Now, this is going to be interest. I think interest we don't take into account if it's going to be firm. Let me just check what are you saying. Past. Yes. Okay, past. Very good. It's past. Okay. Let me just check any other past questions here. Okay. Admin issues. Okay. Oh, very good. All past. Emma, Safi, Dulashi, Muhammad. Oh, thank you for participating. Now, this is all past. Well, some students may be confused. Yeah, my students, they say, well, is it past or future? Well, income statement extracts. Okay, year ended. Sounds like past. But anyway, even if you're stuck in exam, you're going for September 2018 exam, I believe. That particular year, this particular paper was actually a June 2011 paper. Okay, if you are sitting on that day, you would know this is past. Okay, you would immediately know this is a past data given to you. Examiners always using current years in his paper, so it doesn't matter. Okay, so this is going to be obviously that's another way of looking at that. This is past. Okay. Net interest, we're not interested. Taxation, fine. After tax profit, dividends, all we don't show in this free cash flows. Coming back to that later. And you have this paragraph number 4. Further has a market debt equity ratio of 10:90 and estimated equity beta of 1.53. Now, there was one guy in my class asked me this question. He said, how come you got equity beta when it's not listed? Well, then I told him straight. Examiner is very careful in his words here. He just put here estimated beta. That means he have got some other proxy company, probably. And he said estimated. Like here, he didn't say the word estimated. Here he purely puts equity beta. So this is estimated equity beta. Probably they have got what do you call this, value gearing adjustment done, and from the proxy company and all the stuff. Okay, 1.53. It can be assumed that TAD is equivalent. Now this is out of 10 questions. I think our examiner likes to put 7 questions. Your TAD equals to the annual reinvestment to maintain your current operational levels. However, there was additional investment. This is common. Additional investment, 22 cents per $1 sales increase for the next 4 years. It is anticipated that Fodor will pay an interest of 9%. Remember, you need to find free cash flow, present value for free cash flow, present value for free cash flows to the firm. What do you use? Free cash flows to the firm. What's your discount factor? Have a go. Come on. What is your discount factor for firm discounting? Yeah, tell me. Yeah, just check. Very good, Ahmad. Yeah, it's WACC. Is that okay? It's going to be a WACC. Yeah, it's going to be a WACC. KA will be used if it's going to be a free cash flows to equity. So now you know why they give you the debt and equity estimate. This is just the estimate of the market value of the company. This is going to be your cost of debt. That will be that's the nearest cost of debt. Probably the equity beta will be used to find the cost of equity. So all in all, you are ready to compute the WACC. There will be marks for WACC. Is that okay? If you don't know how to find a WACC, just put in a figure and assume and continue your life. Is that okay? Don't lose out the easy marks, especially discounting the forecasted cash flows. Now, paragraph number 5, for the next 4 years, Fodor's sales revenue will grow at the same rate for the previous year. So no wonder they give us the sales from here to here to here to here. There is a average historical growth for, there's 4 years here. Some students will put 4. Funny students, yeah, it should be 3, isn't it? 3. This is 1, 2, 3 years. The reason why they give you this is for one reason. Trust me, all this you can throw away. This one you can throw away. All this is not important. What is important is here to here, the growth figure can be determined using the historical average growth method. Okay. Another growth method which sometimes he uses is the Gordon growth method, when they tell you the payout and all that. Yeah, just make sure you know that formula. After the forecasted 4-year period growth, the growth of sales of the free cash flows will be half of the initial sales growth for the next foreseeable futures. Now, this is a common type you will see if it's going to be a big question. There will be 2 growth rates. First 4 years, it's going to be a growth rate will be determined by the sales. The next 4 years onwards to perpetuity, it will be half. Okay, now that's going to be Fodor's value. And paragraph number 6, with KIV first, that's going to be the combined value. What are we doing here? Don't forget, you must have a goal. You know this value already. Now we want to find this value, and then we will see how much you're going to pay. Then we're going to find this value. Okay, let's say we've got 40 here. Then you're going to get here, let's say 200. Okay, then you see how much you're going to pay. All this comes to play. So we are actually establishing the value of Fodor. Now, let's keep that in mind. So paragraph number 4, 5 is going to be Fodor. 6 is going to be for combined company. We'll come back to that later. 7 is combined company. 8 is also combined company, beta, and all the stuff. Let's go to paragraph number 9. The current annual government base rate. This is going to be your RF. Okay, RF is for CAPM-KE. And market risk premium. Now, I just wanted to be careful with this word, market risk premium. Some students just put RM6 and then they got minus again with 4.6. Okay, this type of simple mistakes you should not do in this paper, AFM paper. as you call today. Now, the relevant annual tax rate is 28%. Okay, we'll keep to this later. Okay, this is for other parts of the question. You can have a read there slowly. Okay, don't worry much about this for today. All right, what we are interested how to see the common type of question that used to come out for your exam. Yeah, we have 10 hours. Remember, we only have 10 hours. I can give you the full answers, but I'm afraid that I can't do other important areas that I plan to do today. Okay, now let's start. First thing first, you're going to have an appendix. I'm going to open up a few windows here so that I can flow. Okay, this is going to be for my workings. I'll have workings. Don't worry, so long as you put appendix, you get a mark. I'm going to teach you how to get the 4 marks here today. You put the appendix, just call appendix. Yeah, I'm sure. Yeah, you can put workings, of course, but then you must have an appendix later. So I'm just going to standardize my answer. I'm just going to call workings, but make sure later when you start your main answer, you put appendix for the computation. So we have here workings number 1. This is all referencing. You can put W1 and all that. So growth is equals to, don't write the formula. Is that okay? Don't write the formula. No marks for writing the formula. Straight to the point. It's 3 years of the current sales. The current sales is going to be 16,146. Comparative 3 years ago, 13559. 16146 into 13559, and you're going to minus 1. Some students just going to put a roof there and make sure that it is under the roof. No, this one stays outside the house. Is that okay? This is going to be minus 1, giving you an approximately 6%. Is that okay? Approximately 6%. Okay, good. Now, that's number 1. You will get marks for that. Number 2, working. I think we're going to see the WACC of folder. Okay, the WACC of folder. You can call it F if you want to after this. Okay, abbreviations are allowed, provided first time you put folder, then you put F. Okay, because F is not an abbreviation. Try to be professional here. If you have CAPM, WACC, okay, all these are allowed. Modigliani and Miller, M&M, yeah, all this should be allowed. Board of Directors, BOD, all these are standard abbreviations allowed. Okay. All right, now you have this KE. I think KE is, oopsie. Okay, KE is going to be, anyone can give me the answer? 4.5 plus 6. That's your, what do you call that? 6 is going to be your market risk premium. Okay, multiplied by, all this can be found in paragraph 4 and 5. Sorry, paragraph 9. Sorry, paragraph 9. Market risk premium is 6%. There you go. This is going to be multiplied with 1.53. You're going to get an answer of okay, there's some questions here. Can we assume KD is pre-tax? Yeah, it's always, if they didn't tell you, it's always pre-tax unless and otherwise they tell you. Okay. Explain the tax shield on the tax deal. Okay, come back to all this later. Okay, so what you're going to get here is 13.68%. Charger. Okay, so then you have to calculate your WACC. Okay, then you have to calculate your WACC. Your WACC is going to be straightforward. Okay, wait, let me plug in my cable for charge. Okay, now, oops. So your WACC will be starting off by KE and the proportion of equity as well as proportion of debt. Okay, so straight away go for your WACC here. Don't write formulas. Okay, I know you know how to write the formulas, and try not to round up these figures. Is that okay? Try not to round up these figures. 13.7 is fine. 13.68, 90 plus this cost of debt here, as some of you are asking. This cost of debt will pay interest. That means you're going to pay interest. Let me just clear this thing here, okay? Will pay interest 9%. This is before tax. This is before tax. It has to be 1 minus 0.28 multiplied by 10, and you're going to get here in bracket $100. So this is, sorry, 100%, okay, 100%. So giving you an answer of 13%. Check. I think it's about 13%. There you go. Now, any other workings I think we need to show is going to be one working. You can avoid that working, but it's difficult to explain via shortcut. But let me just share this working with you. For the next 4 years, the sales revenue, sorry, not this one, the maintenance, that there will be an additional investment in assets, 22 cents for every dollar increase in sales revenue for the next 4 years. Okay, for the next 4 years. So what we're going to do, we're going to have another workings. This is going to be your new capital expenditure. You can call capex, no problem, it's standard. Yeah, new capital expenditure. This says that the next few years, every dollar increase in sales, 22 cents will go for the additional capital expenditure. This is for the next 4 years. So for year 1, there will be an increase in sales. Last year's sales, as per 2011 ended, was 16146. So you're going to get here 16146, and this is going to increase by 6%. Is that okay? It's going to increase by 6%. So you're going to have there 1.06. It's going to give you this figure. So what you're going to do is you're going to multiply with 0.22. Every dollar you're going to have an increase, 213. So that is going to be your incremental capital expenditure that you need to spend. Same goes for year 2, year 3, year 4. Let me just show you one more. This is going to be 17,115. Last year becomes this year's closing becomes next year's opening. So into 1.06 is going to give you 18142 multiplied by 0.22. It's going to give you 226. Is that okay? And so on. You need to do so on. You need to do for year 2, year 3, year 4. But I think I'll do a shortcut. If you're a mathematician, you will understand that this is simply take the first year and keep multiplying with 1.06. Keep multiplying with 1.06. You don't have to show until year 4 in exam. Yeah, trust me, it's going to be sometimes too taxing. The problem with some students is they know everything and they write everything. They try to write everything, and their lack of time at the end of the day, especially for Q1. Yeah, question 1. So you have this already. This is going to be your workings. Let me open up another window, and we're going to go to the other appendix. This is my official appendix here. I think you will get a, even if you put appendix here, doesn't matter. Is that okay? Even if you put appendix here and start with working, I'm not sure. I think they should give you 1 mark. Is that okay? The markers should give you, but I'm not sure. I think it should be. Yeah. What do you think? It should be. Yeah. No problem. Don't worry. Markers, I mean, they have heart, I think so. They do have heart, yeah. I mean, when I mark my students' mock exams, I just give them a mark. Yeah, motivate them a bit. Okay, good. Appendix here. Officially, we're going to call appendix. Appendix, we're going to have valuation of folder. Okay, valuation of folder. Well, you're going to do a free cash flows here. Let me just draw some lines. Here. So we're going to have presentation. It's vital. So you're going to have a few columns to be drawn. 4 columns at least. Okay, 4 columns at least. We're going to have it organized well. Okay, organize it well. Year 1, year 2, year 3, year 4, year 5 to perpetuity. We're going to have sales. Okay, I'm not going to show all the workings. It's going to be 6%. Just blue color. It's going to be 6%. We know that this is 17115. Okay, 18142. 19230, and you got 20384. This is simply adding on 6% to the thing. Okay, that's it. Draw some lines here. Draw some lines. Okay, then we're going to have operating profit, which they didn't tell you any operating profit forecast here. What you can say, very simple. Some of you may want to calculate margin for this. Okay, I think up to you. You want to calculate margin for this, go ahead. But even if you calculate margin, what you can simply do is everything is going to grow by 6%. So there you go. Just put 6% is fine, I think. Just put 6% here is good enough. From the last year's profit is 5169. 5169 plus 6%, you're going to get 5479. 5808 plus 6%, you're going to get 6156. 6526. Okay, then you're going to have tax. You're going to have tax, which is 28%. You can calculate your tax. I calculate for 1 year for you, 34. Or you can just take straight away 72% profits after tax. You can just straight away put that 72%. You can get rid of 28%. That saves some time, but it's nice to present it this way. Yeah. And the examiner have told us, in fact, at paragraph number, where is that? In some of this paragraph, number 4, they said that this tax allowable depreciation is equivalent to the amount of to maintain current. So remember that they have got, this is operating profit, which we have taken into account, and we have increased by 6%. Inside there is a TAD, and your job is just to simply add them back. Okay, your job is to add them back, but there's no data for amount of depreciation. But don't worry, you just have to add them back. What you just do, just tell the examiner, just tell the markers that, look here, it's going to be add TAD. You don't want to tell it's fine, but one of the particular years, I saw a marking scheme, they give 1 mark for mentioning this. One of the year after that, I didn't see this anymore. So less capital expenditure, which is the same, or just put here X and X bracket. It's fine, and just detour to year 2, year 3, and year 4. I'm sure you can find this. This is going to be, well, this is going to be 28% on this. If you got a time, just take 6%, also can. No problem. Less out the new capital expenditure. The additional capital expenditure as per your workings, you got 213, you're going to get 226, you're going to get here 239, and you're going to get here 254. Is that okay? 254. Okay. All right. Yeah, just take photos or screenshots, okay? Just take screenshots just in case you are not copying that. Just take screenshots and all that. Then you can compile them later together yourself, okay? So you're going to have this thing here. Of course, this is nothing, but there must be some figures here, okay? You got to put in some figures. Now, if at all you have got no time in exam, if at all you got no time in exam, just calculate 1 year. Of course, you might not get the full marks, but something better than nothing. Is that okay? 300. Then you just add on 6% to this figure. You can get close figures. Is that okay? You can get, in fact, exact figures. 41.92, 44.45. This is going to be called free cash flows to the firm for business valuation purpose. Your discount factor is 13%. This is 885. I believe you know how to get this from your calculator or tables, doesn't matter. All right, you're going to get these figures out. Okay. And you're going to get here 3301. I'm just going to give you present value figures here. 3096, 2905, 2725. And this is going to be some tricky parts. Some students really don't know how to do at this level. Let me just go slow. What you need to do here is go and see what the examiner is saying. Here, the examiner is saying that the additional first 4 years will be sales revenue grow at the same rate as the previous year. Sales revenue will grow. And then the next 4 years is the growth rate of its free cash flows. They're not talking about sales revenue anymore. They're not on the sales revenue mode. This is the free cash flows will be half of the forecasted growth that you have got earlier. So earlier we have got 6%. Now we're going to make it half. That this is the free cash flows that is going to grow. Treat this as year 0. That means this is going to be year 1. Is that okay? So this is going to be 4445 DO. So remember the dividend formula, DO 1 plus G over KE minus G is just a substitute DO with free cash flow to the firm. Substitute KE with the WACC. There you go. So this is going to be 1 plus J. Your J is going to be 0.03. Okay. Can you hear me okay? All of you can hear me okay? Ken, I think there's some technical issues here. Audio has issues. Oh, can you hear me? Clear. Okay, I think can hear me. Okay, good. Just got a message from Kishore here. Yeah, I think it's fine. Back to normal. Okay, good. Clear now. All right. Let's go back. Now, so this is again coming back here, 44,4445 multiplied by 1.03. This is equals to, is exactly like free cash flow O 1 plus G WACC minus G. So this is going to be your WACC 1.13 minus your G. Actually, you have discounted already. But the thing is that this is year 5 to infinity. Imagine this is year 1 to infinity. It will end up in year 0. But this is not year 1 to infinity. This is year 5 to infinity. So it's going to end up in year 4. Okay, so what you have to do is you join this member, this flow is going to present value by multiplying with a discount factor of 613. This is year 4. Year 4 go to present value, you multiply by 613. This will happen to be year 4 as well. It will have to go through 613. All of you clear with this part? Anyone wants explanation on this one? This is perpetuity cash flows halfway in between. Yeah, halfway in between. You're going to get here 28065, giving you an answer. Okay, giving you an answer of, totaling it up. When you total it up, okay, when you total up, you're going to get valuation of the firm for folder, okay, which is equals to roughly all the figures are 1,000. Forgive me, I didn't say that just now. Valuation of the firm is going to be 40092. Okay, Abraham Steffi is asking, why do we need to use this same discount rate here? Okay, now let me just tell you, if it's a cash flow, this is basics. Okay, this is basics. This is going to slow us down. This is year 1 to infinity. When you do a cash flow year 1 to infinity, you're going to start with whatever cash flows that you got, present value. Use the formula, free cash flows, 0, 1 plus G over WACC minus G. You're going to get a year 0 value. So all these figures you're going to take and put them into here, you're going to get year 0 value. But on the other hand, if you take year 4 to infinity, or year 5 in this case to infinity, you're going to do the same thing, but it's just that you're going to take free cash flows 4 growing at 1 plus G into infinity. So what we do here is you take the whole thing. You cannot be saying when you use the same formula, you still go back to year 0, isn't it? You are actually going to landing. You're going to soft landing at year 4 base. And year 4, you have to still, it's not a present value yet. Year 1's fine. Year 1 is fine. It goes to year 0. And technically, it's already present value. Year 5 to infinity, what you have to do is you're going to landing in year 4. So what you have to do always, if it's not the year 1 onwards, is just remember this simple trick here. What do you do? If you take year 5 to infinity, then you must put year 4 discount factor so that you get the present value. I hope it's clear. Okay, now okay, you're going to get there 40092. Yeah, there are many methods there, but just check your methods should give you the same answer. Yeah, it should give you the same answer, whatever you do. Okay, different methods will give you different approach, but the answers end up being the same. So this is going to be firm value, which is going to represent the value of equity plus the value of debt for folder. And we're going to now do another working now for the combined company. Now we are ready. We have got one. We need to find one more. Yeah, we need to find one more. Now, if you ask me this question, came out in 2011. It's similar questions have come out before. Previously, there was one question called Pexis way back ago. Yeah, kind of similar. Okay, so that's why I was telling you, just do past year questions. Just keep practicing. Yeah, you will get through. I guarantee you pass. I tell my students, I guarantee you pass if you do all the questions from December 2010 within the exam time limit, without referring to suggested answer. Within the exam time limit, if you can do all December questions, you will pass. Yeah, you will pass. Okay. Now, the combined company information here, we got the following acquisition. Is expected that the combined company sales revenue will be 51,952 in the first year, and the profit margin will be 30,000. This is combined company. So we are going to find out the present value of the combined company free cash flow method. As I've said just now, we are now actually going to, we got folder, pursuit folder. We already know this is 140. We already know this is 40, but we need to find out what is it? What is the value for this? What is the value for this pursuit folder? That's what we're going to do now. Okay. Okay. They tell you there's a margin. Why they have to tell you the margin? Because previously there was no profits. And the sales, previously there was no sales from folder to bring into pursuit. So we are going to take given figure 51 million. Again, they're telling you cost of debt, which is going to be for your WACC calculation. First year, they're telling you it's going to be 5.8 for the next following 3 years. Same 3 years means first year growth 5.8, following 3 years, again it's year 4, year 5 onwards, it's going to be, I think it's half again. Yeah, it's going to be half again in paragraph 7. The combined company will require additional investment in assets 513 in the first year, and you're going to get 18 cents per $1 increase in revenue for the next 3 years. Again, the concept is the same. Earlier was 22 cents. This time is 18 cents. First year additional. First year they have to tell you because there was no track record for the previous combined company. This is the first time we are going to combine. Okay, it is assumed that yes, this is a tricky part. This is a tricky part. Later I'll teach you. If you're not sure, just forget about this and just take a guess at one figure and move on. But you're going to lose maybe 2 to 3 marks there. Maybe two marks for not getting the beta correct and all that stuff, because the cost of capital will be wrong. Okay, it can be assumed that the beta asset of the combined company is the weighted average of the individual company's beta asset. Wow, weighted in proportion to the individual company's market value. Okay, weighted in proportion to the individual company's market value. Okay, we'll come back to this weighted story in a while. So let's go back to, we got a workings here. So my workings page is here. Page workings. Okay, combined company WACC. I need that. I need What happened actually? Okay, sure. Okay. All right. Thank you. Thank you. Okay. I thought we got disconnected. Let me just change the headset mic. Okay. Just check. All of you back? Are you guys good? Can you hear me? Okay. Okay. Very good. Yeah. All right. Let's start. Apologies. Okay. I don't know what happened. Okay. Now, again, where was I? I think I was at not sure where I was talking while they were dismissed as well. Okay. Now, this is going to be your combined companies information. We're going to find the combined company WACC here. But the problem of the combined company WACC is that they got tell you in paragraph number 8. In paragraph number 8 is going to be, it can be assumed that the asset beta of the combined company is the weighted average of the individual company's asset beta weighted in proportion to the individual market value. Wow. Okay, what can you see here? They're talking about asset beta, asset beta. Okay, so what's the first thing? Even if you're not sure how to do, just find asset beta. There will be marks for finding asset beta. You are given 2 equity beta. Remember, you are given in paragraph 4 equity beta for folder, and you are given in paragraph 2 the equity beta of pursuit. So they say asset beta, so don't panic. You just get the ungeared asset beta. Okay, so this is going to be the formula. Well, you can skip this formula if you want to, but I'm just writing. Some students are guided by the formula. Certain formulas you want to write, go ahead. But if you can, avoid this, because this is going to take some of your time. And don't even write the back side. We just put beta depth is nil. Remember your assumption in the next part. That's where you're going to talk all this assumption. Don't continue the formula till the long. Yeah, no need to write beta depth, multiply by all that. No need. So what we're going to do, let's get the beta asset of pursuit first, because they say beta asset. Let's ungear pursuits beta asset. Ungear pursuits beta asset, which is going to be equals to beta asset equals to pursuit 1 is 1.18. Paragraph 2, and pursuit has got 50-50, or you can take 70-70 is fine. 70-70 also can, 50-50 also can. So you're going to get here 1 minus 0.28, and you're going to get something like 0.686. Okay, you're going to get that 0.686. One row, get the figures out. Is that okay? Just you got a nice calculator. Just do it one shot. Now we're going to have to ungear folder. Is that okay? Ungear folder, same story. Beta asset equals to, we are given beta equity of folder in paragraph number 4, 1.53. That's going to give us 1.53 multiplied by 90 over 90 equity plus debt. 1 minus tax. Tax is because the benefits is going to be taken by tax shield. Okay, so you're going to get this figure as 1.417. You got 2 beta asset. Let's go back to paragraph 8. What did it say? It assumes that the asset beta of the combined company, okay, one combined, is the weighted average of the individual company. You just got 2 beta asset of pursuit, and folder is the weighted average, not simple average, using the proportion of the individual company's market value Okay, I think we have the combined company market value, combined beta asset, value of pursuit was 140 million. Value of folder, we just got that one from the free cash flows to the firm value, which is going to be 40 million. We're going to get here 180 million. So we're going to do a weighted average beta asset. Okay, weighted average beta asset, just like your WACC formula. You take your pursuit one, 86, multiply by 140, plus you take your folders beta asset, 147 multiplied by 40 into 180. Okay, you have got the answers. Okay, you should have got something like in between these two figures, it will be hovering around 848 or 85. You get marked for this. You get marked for beta assets of pursuit. You get marked for beta asset for folder. You get marked for weighted average beta. Even if it's wrong, you continue your error. It's okay. Is that okay? Just please continue until the last answer. Okay, then what you have to do, you have beta asset of combined company. Now you need to re-gear. Okay, you need to re-gear. So this question I've chose for also to explain to you re-gearing, ungearing process. Some of them call it de-gearing, etc. Okay. Okay, so we're going to have here re-gear to the new company equity debt. New company equity debt. So, okay, new company equity debt in paragraph number 1. They got say in paragraph number 1. They said remains the pursuit. If you miss that, they are also going to say in the requirement here that assuming that the combined company capital structure remains the same of pursuit, so it's going to be 50-50. Is that okay? It's going to be 50-50. So you're going to re-gear using 50-50. Now use back the same formula because that's the only formula given in your formula sheet. I always use back the same formula. Just use back the same formula. What I know is I know beta asset. Beta asset is 0.848. What I have to do, beta equity is what I want to find. The value is 50-50 because it's just a proportion. 1 minus your tax rate, 0.28. It's going to give you an answer here of beta equity of 1.459. 1.46 is good. What's the next step we're going to do? The next step we're going to do is going to be a KE, which is going to be 4.5 RF plus 6. 6 is going to be risk premium. 1.459 beta. You're going to get here 13.25%, and you're going to get a WACC straight away using the same proportion as pursuits companies capital structure. You take 13.25, multiply with 50. I'm going to put 100 later, can go ahead. Plus, what's your cost of debt here? Where is it? Where is your cost of debt? Your cost of debt is combined is going 6.4. It's going to be 6.4%. 1 minus tax. All tax rates are the same. Multiply by 50. Instead of divide by 100, divide by 100. You one shot divide by 100. That'll be saving a lot of your time. So in between here, you're going to get 8.9%, and you're going to get here around close to 9%. So you must come until here. If your steps are all correct, if this is wrong, you still get that particular mark. Usually it's 1 mark for this final figure. Okay, so we are done with the workings. I think we are ready to do the appendix for 2. Appendix 2, you want to call appendix 2 or appendix 1, also can, doesn't matter. We're going to have valuation of combined company. Okay, valuation of combined company. You're going to have here, let's get the lines there. That's how I draw my lines now. Some of you may say, oh, I don't want to draw lines. Fine, if you don't want to draw lines, it's okay. Yeah, but make sure you are running at the same row, okay? Parallel, okay? All right, what do you have here? Year 1, year 2, year 3, year 4, year 5 to infinity. This is going to be sales given. Is it given in paragraph number 6? Okay, 51952, all figures at thousands. All figures at 1,000. Maybe you can just write here, all figures is at 1,000. You're going to get here 51952. And there you go. You're going to just increase it by 5.8%. And you're going to increase it again by 54,965. You're going to get here 58,153, 61,526. Okay, just close that one. Just close it off. And you're going to get here operating profit. Operating profit. Now they did tell us that it's going to be 30% margin on sales. Now this margin is, as we see earlier in further, this is after TAD. Yeah, after TAD, unless they tell you before TAD. This is after TAD. So we're going to take 30% on this figure. 30% on this figure, which is 15. Just use another color. It's going to be 15586. You can go on 30%, 30%, 30%, or you can just put 5.8%, 5.8%, 5.8%. You have a go. Tax will be equals to 28% on this figure, or you just take 72% on this figure. After tax is also okay. 4364, and you're going to go 38%, 28%, 28%, or simply 5.8%, 5.8%. 5.8%, there is an additional capex. Additional capex. Here they say here 513 in the first year, rising by 18 cents for $1 in sales revenue for the next 3 years. So first year is 513, rising by 18 cents. What you have to do is you take this two difference. Yeah, you take this two difference. That's your sales increase multiplied by 18 cents. Give me a figure. Is it correct? Okay, that's one question. Should we put appendix only free cash flow calculation? Not necessary. Appendix you can show WACC calculation, all can. So okay, no problem. You can put in all your workings, no worries. Yeah, I feel no problem. Yeah, I personally feel no problem. Appendix, yeah, you're trying to be professional, but in exam you can't be very particular about appendix 1 is for what, appendix 1 is for what, and all that. Okay, very good. We have here from Mutas giving me 542.34. Thank you. So we're going to have here 542. You take the difference between these two and you increase it by how many percent is that? 18 cents. Is that okay? You take the difference between these two, multiply by 18 cents, but make sure you put a bracket. Or what do? You got this as 5.8%. This is shortcut, faster this way. 5.8. Sometimes you do 1 year, then you feel, hey, I can do this method. Yeah, but before that you can't see. Yeah, then you just keep pressing 5.2 because your sales is going up by 5.8. Obviously, your capital expenditure also should go up by 5.8. This is going to be equals to 574. This is going to be equals to 604. There you go. You're going to get these answers out there like this. Okay. Now, what we're going to have here is we're going to have here free cash flows to the firm. I got my answers here, 709. Well, 11331. Just check, is it 5.8? Just check, is it 5.8? 11987 and 12683. Okay, this is going to be a discount factor at your combined company WACC. There was a working for this, so just tell the markers, going to look for the workings. And this is going to be 0.917. I'm just going to put these figures down here. 0.772, 0.708. Okay, you're going to help me together. Okay, before that we see any questions here. Subtract capex. Yeah, we did subtract capex. Yeah, we did subtract capex. Where's my questions now? Questions are missing. Oopsie. Make it bigger. Wait, hold on, give me a sec. Okay. How to bring it back? Never mind. Okay. Never mind. When you answer me, I'll get to know you. Okay. Give me a minute. Okay. So now you're going to tell me, this is going to be your 5 to infinity, and this is going to be half of the, again, half of the sales growth, which is 5, where is that? 5.8. Half is going to be 2.9%. You help me out, okay? You help me out. What we're going to put here, you're going to put here with 12,683 multiplied by 1.029 over 0.09 minus 0.029. This value is year 5 to infinity, but when you do this, this value is sitting on year 4. Okay, this value will be sitting on year 4. What you have to do is you just have to multiply again by 0.8. 708. There you go, finish. That's it. Simple as a piece of cake. Okay, now, so can multiply, you're going to get these figures out. You're going to get this present value out. I believe you can do this. This is going to be 151,475, 9820, 9541, 9254, 8980. So forgive me if I'm writing fast. Okay, I just want to do one more question with you. So this is going to be your value of the firm. Let me clear these lines. Okay, this is going to be the value of the firm combined. Total this up, 180,070. Okay. Okay. All your timing, I'm not sure why your message is not. Oh, okay, I can sort your timing here. Okay. Okay, let's see some questions here before we move on to the answer. We've got some questions here. 5.8. Don't we subtract capex? Yes, we did subtract capex. TAD. Assumption here, TAD is equals to existing capex. Yeah, TAD is assuming here. We have to assume that one because we don't know the TAD in this question. Emma, okay? Emma, okay? Yeah, we don't know the TAD, so we just have to assume for the combined company because yeah, the margin should include TAD. I believe so. Okay, the margin should include TAD. It's going to be the same assumption that we have to use there. Later we have to talk that assumptions in the assumptions paragraph. Okay. Next one you have this Iman is asking us 9820 in year 1. Okay, thank you. That's the answer, I think. Capex in year 4 607. Wait, Capex in year 4, is it 607? Check. Well, I'm not sure. Is it 607? I'm sorry, maybe it's 607. I'm not sure. Okay, good, no problem. Small matter. Okay, very good. Wong Lei Hui, I'm not sure where you're from. Yeah, sounds familiar. Okay, so if the market is more or less than valuation as per dividend model, then what does it mean? Well, we'll keep that. More or less the valuation as per dividend, then what does it mean? Market cap is more or less, market capitalization is more or less as per dividend valuation model. That means I can say here, maybe many shareholders are there. Many shareholders are present and maybe no one is having strong control. So whenever there's many shareholders, small shareholders, if you are saying market cap is very close to dividend valuation model, then probably no one is having acquiring control. Earnings is not relevant. Free cash flows is not relevant. People are basing the valuation on purely dividend method. People are only interested in dividends. The clientele of the shareholders are interested in the dividends only. Okay, I hope that answer Martia question. Next one, Nikki. So do we need to show? Yeah, I think I've answered that question, Nikki. Yeah, he's an accountant. Who's that? Not sure who. Okay. How WACC affect share price? Okay. Branson Lee. Okay. Yeah, your WACC will affect your NPV. Okay, that's number one. WACC will affect your NPV, and NPV will affect your share price. That's how it's connected. Okay, good. All right, let's go to here. Okay. I'll put the frame here. I'll put the frame. We need to do one more appendix 3. We'll need to do one more appendix 3. We'll come back to that appendix 3 in a while. Yeah, we need to do the appendix 3 in a while. Let's go and write our report. Now, the report writing. Yeah, just come back to this appendix later. Report. Now, you're going to have a structure of the report. To, from, date, subject. Okay, make sure you have this written properly. You should get a mark for this. You should get a mark for this. There are 4 marks here. There are 4 marks for structure and presentation. 1 mark you already got. I always tell students, you start the question with 4 marks in hand. Yeah, examiner is giving you 4 marks. You just need 46 marks to pass this paper. 4 marks is already in your hand. Okay, so you need to have another 46 marks. Now that this 4 marks, most of them should get at least 3. Easily, you should get at least 3, if not 4. Okay, don't miss out. Yeah, I see some of my students. I mean, my students in when I give mock exams, they just don't listen. They just don't want that 4 marks. They just don't write report. They don't just put the word report. Those days, you just put the word report, you get a mark. Those days exam. Today, you must put report to from subject, or you can put report to, and the from and the date, you can push it at the bottom of the report. Some the examiner does that way. or just put all together. Make sure you get the marks easily, 1 mark. Then you have to have your introduction paragraph. Yeah, I would give like this. If let's say I'm marking, I'll give introduction and conclusion paragraph. I'm going to give you 1 mark. You got a proper conclusion. You don't write conclusion like this project is good, go. No, that's not the way you write. You write proper, convince them. Because if I'm a board of director, if I'm not going to read, seriously, to be frank with you, if I'm going to be a director of a company, you're going to put a thick report on my table. First thing I'll read is the introduction and the conclusion, full stop. Then I figure out what's inside the report. So if your conclusion is going to be like flimsy type of conclusion, well, you're not going to get that 1 mark. Intro, paragraph, conclusion, you're going to get a mark. Appendix, 1 mark. Report, 1 mark. And you're going to have this clarity, persuasiveness. Okay. You put lots of headers inside. Yeah, if your handwriting is horrible, if you're born to be a doctor, maybe you might not get the 4 marks. Yeah, you will get 3 marks. Yeah, I had doctors in my class before. They just don't get that 4 marks. Yeah, okay. So you're okay with that 4 marks there? Yeah, you have to. Yeah, don't forget this 4 marks, Emma, is going to be very important. Yeah, sometimes if a candidate doesn't write the report format proper and it gets 49 marks, you're going to bang your head on the wall, I tell you. Yeah, 4 marks. If you don't write report and you fail marginally, it's your fault. Yeah, it is your fault. Okay. Coming back here, we're going to have this report here written. Then we have the introduction paragraph. You just write a proper introduction. In this report, just like in this report, what are you going to do? Okay, in this report, we will, number 1, evaluate the acquisition. Number 2, we will discuss the limitation very quickly, briefly. Okay, don't copy the whole thing. Number 3 is we're going to estimate the amount of debt finance used, etc. in this report. So what you put, the requirements here, you summarize the requirements and you put that. That's the introduction part. Next, we're going into the first paragraph. Now, those days, whatever you calculate, you have this 25 marks here. 25 marks here. Now, in this particular question, this is an old question. Whatever you calculate, you bring it back to the report as a summary to explain what have you calculated. Yeah, but I've seen the current exams, the marking scheme, they're giving you all the marks in the appendix. But you still have to make reference to the appendix. Is that okay? You still have to make reference to the appendix. Okay, so we're going to start our first paragraph here. Introduction done. Now I'm going to write like this. I'm going to have lots of headers in my report. Beneficial. Is it beneficial to shareholders of Pursuit? Okay, on acquisition of Folder. Okay, now we're going to say from appendix, whatever appendix you have, from appendix 1, just keep it simple. From appendix 1, the value of the firm of Folder is going to be 40 million. Check. Therefore, the value of pure equity, is in that paragraph number 4, I think. 40 million represented by equity is 90%, so it's 36 million. Okay, that's okay. And for the shareholder desire 25% premium. Okay, 25% premium on this value. Yeah, or 25% premium on this value. Okay, further shareholder desire 25% premium on this value. This is found in paragraph number 1. Okay, therefore, okay, therefore, okay, I'm just giving you a shortcut here. Therefore, further's price for equity, you got to buy that equity. Okay, you got to pay for it, will be how much? You're going to pay 36 million multiplied by 1.25 is equals to 45 million. Okay, you're going to pay 45 million and you're going to take over the debt as well, and therefore it's either you take over the debt or you're going to pay off the debt, and we'll pay off the debt or take over the debt. Pay off the debt off. How much was your debt? Well, it's 10% on this 40 million. Is that so? So it's going to be 40 million times 10%. So it's 4 million. So in other words, you're buying this company, you're going to pay 45 million and you're going to take a debt worth 4 million. In other words, the consideration that you are going to pay is 49 million. Okay, so therefore all this will be in one mini small paragraph, or you can break it up into 2 or 3 paragraphs, but make sure your header is still the same. The header is beneficial to shareholders of Pursuit, whatever. Yeah, make sure you write, don't put all in one big paragraph. Okay, break it up into some small paragraphs there. Therefore, Pursuit, okay, Pursuit will need to pay how much? 49 million. And from appendix, whatever, appendix number 2 or whatever, the firm value combined. The firm value combined was how much? Give me a figure. Well, we know it's 189 million. 189 million. So if you summarize it in this manner, your value is, where is my, okay, your value was 140. The combined value 189, and I'm going to pay you 49. So what is there for me? Nothing. Can you see that? My value 140. I'm going to get 189 after I pay you something. Then I realize I paid you 49. In other words, I get nothing. So very marginal answer here, correct? Very marginal answer. So 189 was 189. Value of the firm combined was 189. Therefore, the value of the firm added by further. The extra value added was how much? 49. Okay, 189 million. Take away my original value 140. That means I have gained 49 value, and I need to pay as above. Pay as above 49 million. Therefore, you can come to a conclusion. There is no real gain to buy further. Okay, there's no real gain to buy further. Quickly, we're going to have to just write the limitations. Limitations is usual, I've said here. Limitations, it's going to be limitations, but there are limitations of free cash flows to the firm valuation. How many marks there? 4 marks. So you must write at least 4 sentences. Is that okay? Yeah, don't write one sentences. You know there's going to be 4 sentences. Please write 4 sentences there, okay? You can put numbering if you want in the report, no problem. Just don't put bullet in the report. Yeah, some people might not like it. Number 1, you're going to say forecast. I'm just going to write in short sentences. Forecast is accurate. Assume that the forecast is accurate. So that could be wrong. Yeah, limitations that my forecast could be wrong. Maybe you got to add on by saying you need to do sensitivity analysis. Maybe you want to do some VAR, value at risk techniques, to measure risk and all this stuff. Number 2, we're going to assume here that the TAD equals to existing asset replacement, which is not so valid. Yeah, which is not very unlikely. It's going to be the same. Very unlikely. Maybe the third one, all this you have to elaborate in a full sentences. Is that okay? Make sure it's at full sentence. At this level, I mean, we don't have time to write for you. Okay, we don't have the time to write for you. Okay, you have to write. Apologize, I don't have the time. Okay, now then you have this thing called growth rates, assumed to be what? Growth rates. Growth rate assumes, is it not sustainable? Do you think it's going to be sustained forever at half the 6% for folder and half of the 5.8% for combined? Do you think it's going to be sustainable? That's the question mark that we're going to talk about here. Fourth one is capital structure. Now, capital structure is maintained at 50-50. There's a question mark there. Can you maintain your capital structure at 50-50? Something like that. It's going to be tricky there. Number 5 is going to be valuation. Valuation is done to perpetuity. Well, that's not very good. Maybe you should take a medium-term perspective, maybe 10 to 20 years perspective, rather than perpetuity. Yeah, it's not so practical. Is that okay? Yep. Let's take some questions. Okay, I hope you're okay with question 1. I'm not answering the whole question, but I feel that these 2 parts are important. All right, let's take some questions before we take a short break. Oh, there's a lot of questions here. All right. Thanks for the warning. Now, should we always add the value of debt? Yes, if you're taking over the debt, that is part of your consideration, Hemraj. Would that reduce the value of an equity? Well, no, it's not going to increase. The value of equity will purely be value of equity. Yeah, but that will reduce the value of the firm that you're paying, because end of the day, what you're getting is net of the debt. TAD limitations. Who's asking? Shaila. Okay. Now, TAD limitations is basically it may not be equal. Here we're assuming that the tax allowable depreciation and the existing additional assets is going to be the same. So in real life, it's not going to be the same. You might buy more, you might buy less, you might even not buy anything, but the TAD will always be there for a while. Okay, I hope it's okay. Why? Yeah, Alexi, we will talk that one actually in part 3 of the question. So here we are not talking about financing yet. Maybe if we have time later, I want to do one question. If I got time, I'll come to appendix 3 on the debt finance. Okay, Alexi? Yeah, if I got time, I'll come and give you that answer. Otherwise, you got to work out your answer that one yourself. Okay, because that is actually for financing. Okay. All right, keep it coming. Okay, we'll take a short 10 minutes off. Okay, just go and grab some drinks for yourself. Okay, we'll come back in about 10 minutes. Okay, hi everybody. Welcome back after this short break. Let's try another question. But before that, can you all hear me? Can you guys hear me well? And I want to take one question from Chayan. He says, any negative marking at this level? If you have negative marking, then you should have students getting negative marks, right? There's no negative marking, I believe. I believe there's no negative marking. Yeah, it's either you get your marks or you don't get your marks. Okay. Can you hear me? Hello? Okay. Yes, okay, good. I think there's some delay in our. All right, very good. Okay, now what we're going to do now is we are moving away from business valuation and takeover and synergy calculations. If I have the time today, which I think I might not have, but if I have the time today, I'll come back to pursuit and talk about the appendix 3, which is going to be on capital structure. Okay, how much is it going to be, the debt and all that. Okay, now what I plan to do now is minimize the screen. Okay, let's go clear this off. Okay. Okay, we're going to do a question called TISA. Yeah, we did SIGRA yesterday. We're going to do a question called TISA. ANIA is good question. ANIA is a good question. If you got the time, please practice this. This is going to be on forecasting. Yeah, examiner do like forecasts for some extent. Okay, examiner loves forecasting, especially statement of financial position forecast, income statement forecast, etc. Okay, make sure if I got a time, I'll start off some forecast with you, but if I don't have the time, my apologies. Okay. Now, which page is that? TISA. Where's TISA? Okay, just check. TISA. If you don't have that, we go to Plan B 13. Okay, come. Now, yeah, it's here. Page 13. Okay, page 13. TISA. What does it want? Thank you. Thank you, Mau, Mang, Wayana, and Emma. All right. Okay. Page 13. Look at the requirement first. I'll answer part A and part B. Is that okay? Part A and part B. That is if we have the time to answer part A and part B. If I got a time, we'll go and do the pursuit on the debt structure. Okay. Now, provide a reasoned estimate of the cost of capital that TISA should use to calculate the net present value for two processes. Now, very quickly, cost of capital can only be three cost of capital. There can only be three types of cost of capital. There's many ways to explain this. One cost of capital is simply your existing WACC. That's going to be your cost of capital. Anybody can tell me what's the second cost of capital? Oh, you want VAR? Okay, Emma we'll do a VAR for you as well. No problem there. Okay. CAPM, well, not really. When I say cost of capital for investment appraisal, what cost of capital are you looking for? One is existing WACC. Existing WACC, another two more. Come on, anyone can tell me, what is the other two more cost of capital? The other two more cost of capital. Answer coming in. Project specific WACC, Basanta, very good. This is going to be project specific WACC, or you can call it risk adjusted WACC. Yeah, F9 examiner calls it project specific WACC. P4 examiner likes it called risk adjusted WACC. One more is going to be what is the cost of capital that you use for APV calculation? What is the specific what is CAPM? Maybe CAPM, it's going to be your KEI. Very good, Emma. KEI, or which is going to be ungeared cost of equity. Yeah, ungeared cost of equity, zero debt, 100% equity financing. Is that okay? Now, when do you use existing WACC? When there's no changes in business risk, when business and financial financing is the same, you use existing WACC. When your risk adjusted WACC, when your financing is the same but your business is different, is that okay? You got a business, different business, you use risk adjusted WACC. When do you use this KEI? When the moment your finance is going to change, you just use APV. Whether your business is the same or not, doesn't matter. Yeah, if your business is not the same, then you need to get a proxy. If your business is the same, then you still stick to your own business and you still do using APV method. Okay, that is not a problem, but this question we're going to find out what is it for. Okay, come. TISA is considering an opportunity to produce an innovative fitted motor vehicle engine which will enable them to utilize fuel more efficiently. The component can be manufactured using either process Omega or Zeta, although this is entirely a new line of business. So, okay, we know there's a new line of business. Business is going to be different. Yeah, my business is going to be different business. Okay, it could be here as well, it could be this one. And I want you to fast forward to this paragraph here. Fast forward to this paragraph. Your examiner is very clear about this topic. He's not going to make it doubtful whether you're going to use risk adjusted WACC or APV. Here it says you're unlikely to change your capital structure, so which means to say your finance is the same, so your business is different, so we are going to use risk adjusted WACC, or you can call it project specific WACC. Okay, coming back here, you got this is an opinion of the development of the process over a period of 4 years and selling the production rights at the end of 4 years to another company prove lucrative. Okay, this is 4 years project. This is a 4 years project. It's a new line of business. Okay, that's a keyword. After tax annual cash flows for each processes are as follows. You got process Omega. Now this is just a process. It's not a product that you're evaluating. It's a process you're evaluating. You got a choice of two processes here. You're going to decide which process you want to do. This is not a project, this is a process. So it's going to be a mutual exclusive investment choice. Mutual exclusive means you can only choose one of these two processes. Cost wise is the same, and you're going to get all these figures coming in here. Just take note of the trend here. More cash flows coming in earlier, more chance for reinvestment earlier, last cash flows coming in later. So it's going to be late in terms of reinvestment. Okay, now Going on, TISA has got 10 million. Number of shares is important. The 50 cents, you can throw it away because they have already told us the number of share. Okay, you must be very careful in this case. Okay, if it's 180 share price, this is going to be your debt value. They didn't say, they say current value, so we'll just take it as market value. And here they're specific about after tax cost of debt, because this is going to be risk adjusted WACC. To do a WACC, you need a KE, you need a KD, you need a VE, you need a VD. All, sorry, this is KD. This figures here will be the same for the existing WACC. It will be the same for existing WACC. The only thing that's going to change is your KE of this new business that you're going to venture into. You're going to look at the new systematic business risk. You got to get a proxy company to help you out on this particular KE. Okay, good. Let me get rid of this. Yeah, okay. Now, Alpha is a manufacturer of electronic parts for cars, including production of similar component to one being considered by TISA. So Alpha is the proxy. So we're going to borrow his beta. His beta equity consists of two risks. Anyone can help me out there? What risk is inside this 1.4? Yeah, what risk is this going to be? 1.4. Two risks inside here. I'll wait for your answer. Okay, answer's coming. Yeah, let's check. Business risk, very good. And financial risk. I think you guys are prepared for exam already. Yeah, you can call for exam now itself. But too bad. Yeah, it's only an European model, right? European model, you can't bring forward the exam. You got to sit for the exam. It's an American model, huh? Okay, 1.4 estimated equity equivalent beta for the other activities, excluding the component. What do you mean by that? Because we are interested in the component, innovative component. So which means there's business risk here, there's financial risk here. This business is broken up into further business risk over here, and then they give you some shares in Alpha. They give you some debt in Alpha. Then they're telling you that they are whatever 120 basis points. This is the debt value in Alpha. 80% of Alpha debt finance is going to be for component other activities. Sorry, 75% of this is a complication for the students. This paragraph is going to complicate things because there's two businesses in your proxy. I only want one business, and I don't want his financial risk. I don't want his financial risk. I don't want one more of the business. I want purely one business only, that is component, which means I'm looking for a beta asset of that component business. If I have that, I can straight away re-gear into TISA's gearing and sort the problem out. Okay, now very quickly, you're going to answer this question. Okay, 2-page enough. Okay, both, by the way, both the company pay 25%. Current base rate is deemed to be your RF, and market risk premium is 5.8%. Now, let's start this question. Let's get some lines here. It's going to be TISA. Okay, we're going to have an approach paragraph. Is that okay? Tell the examiner an approach paragraph. You're going to say TISA is involved in a new business and with capital structure unchanged, we would use risk adjusted WACC. Is that okay? We would use risk adjusted WACC. So next paragraph or next sentence, we're going to say L4, sorry, L4, sorry, L4. Okay, L4 will be assumed to be a good proxy. Okay, P-R-O-X-Y. Okay, proxy. L4 will be a good proxy and assume that beta depth is nil. So these are the two simple assumptions that we're just going to write first. Okay, moving on. I want to break it up into, I like to break it up. There are some information that we need. We know L4 got other activities, which I don't want. I only want the component activities. Now what I have here, I have value of equity of L4, which is given in the paragraph on the number of share of L4. This is all in this paragraph. Just focus on the second last paragraph only. So L4 has got how many million shares? 400 million shares, 120. L4 has got debt 96 million. Assume that is market value as it is. So this is going to be 400 multiplied by 1.2, giving you 480. Value of debt is going to be 96. Okay, and the beta of equity of L4 combined company is given as 1.4 equity beta that consists of the combined companies beta 1.4. And if I want to find beta asset, I just simply ungear the thing. Yeah, I have my data to ungear. I can find my beta asset of L4 if I want. Okay, that's it. Now they go moving on. They're going to break this equity up into two parts here. If you look at the question carefully, 80% of the debt belongs to L4 and 75%, sorry, not L4, 80% of the debt belongs to and 75% of L4 equity belongs to the other activities. So other activities is going to be bigger in size. Okay, so we're going to have here 75% belongs to L4, 25% belongs to component, 80% of the debt comes to other, and this 20% goes to them. So this is going to be 360. This is going to be 76.8. You're going to get 120. You're going to get here 19.2. Okay, get these figures out first, no problem. Now, one more beta they gave us was 1.2, excluding the component production is 1.25. This is the equivalent equity beta for the other activities, excluding the component. That means this is the equity beta. There's only two more equity beta that you need to put. So we are told that this is 1.25. So if I know that 1.25, I can still ungear this particular thing if I want to. Now, the thing is this. The thing is, we are not told this beta equity and we are not told this beta asset. There's 4 missing doors here. Okay, the doors are closed. Now, if I'm going to give you a chance, you open the door and you're going to get the answer that you need. Which door you're actually looking for? Which is the answer you actually want? A, B, C, or D? Which answer will help you to do this question fast? You want to get A? I'm going to give you one of the answers straight. A, B, C, or D? Which one you want? We got A, a lot of people saying A. D. Alexei is saying D. Well, no one is giving me except for, I think we must take, wow, everybody's saying A. Now, if I'm going to give you one answer, I would go with Alexei, which is going to be D. This is what I want. I don't want your business. I don't want your financial risk. I just want your business risk related to component, which is beta asset. Is that clear? So if you can find the D straight away, that's going to make your answer go fast. But too bad you're not told all these figures. So you have a choice now. You have a choice to go to reach D, destination. You find A first, and then you find B, and then you take these two as weighted average to get this. We did just now weighted average, remember? So if you know this and if you know this, you can find this out because this is the weighted average of A and D. Or what you can do, you can do this. You find C first because you know this and you know this. You can find C first and then you just ungear the C, you get it. So which one is faster route? You're going to take that faster way of getting to the answer. Both answers will give you the same answer, if not exactly. There'll be some rounding adjustments. It should be the same. Ungear one time, ungear two times, then you find the average. 3 steps approach. Ouch. 3 steps approach. Or what do? You find the average first, 1 step ungear. I think I'm going to go for C first, and then we're going to find D. That's what we need. We need the business risk of the component, nothing of Alpha's financial risk. So to find C first, you have an issue now. Okay, you have an issue to find the C. So let's talk about this. Finding the beta equity. Finding the beta equity for component business of Alpha. Is that okay? Finding the beta equity of business for Alpha. Slowly, okay? We have like half an hour to go. Okay, we have like half an hour. I hope I can finish with the VR. Apologies if I can't do, if I can't do, but my apologies. Yeah, but these are all past year examples. You can get the answers from answers. Okay, this available. Okay, so we're going to have here beta asset. You're going to have here proportion. Well, you have other activities which you don't want, and you have component which you want. What I have here, oopsie, go up here first. Okay, what I have here is I have 1.25 and I have 1.4. So I have 1.25 for other activities. So I'm going to put here, sorry, this is not beta asset, this is beta equity. Am I right? Beta equity. We have here 1.25, and I'm not sure about component. I'm just simply going to call it Y. Okay. And the proportion here, we're going to take here the proportion. Now, it will always be good if your examiner gives you the proportion. Most of the time, he gives you the proportion. Sometimes, like in this question, he doesn't give you the proportion. What's the best proportion here? You are ungearing, you are trying to find an average of this beta equity here. So equities, you want to split, you may use, well, there are many ways of doing it. You can use assets. Yeah, you can use assets as the proportion. If you use assets, I think I'm going to use assets for this question. Assets are represented by equity plus debt. So we're going to get the total here. We're going to get the total here, which is going to be 463.8. And we're going to get the total here, which is 139.2. In proportion is 76% belongs to others and 24% belongs to component. This is asset basis. Your examiner is okay with asset basis. Or you can use equity as per se, given in the question, 75-25. There'll be a slight difference in answer if you're going to use equity. I've also seen some question where they have used in the very old papers, as well as ACCA, as well as CIMA papers. They have used the size of the business as represented by revenue, sales, turnover. Is that okay? So there are 4 ways. 1, it is given. 2, you're going to use asset, or if not given, then you may want to use equity, or you want to use equity, fine, or you're going to use revenue or turnover to represent the proportion. Okay, so we'll use 76 and 24. Is it okay? We'll take 76%, 76%, which is 0.76, and this is 0.24. Combine this, you're going to get a beta equity of 1.4 of the existing business. So this is mathematical. 1.25 multiplied by 0.76 plus with y multiplied with 0.24. It's going to give you 1.4. So y equals to 1.88. I trust you can do this simple algebra. 1.88 is going to be your beta equity of the component business, which I am actually not interested as direct figure. What I need is I need to remove the Alphos gearing, which is not the same with TISA's gearing. So we need to remove that. We need to ungear this particular 1.88 earlier. So we tell the examiner you need to ungear. Is that okay? Ungear beta equity of the component business. Okay, we're going to ungear that further, and we're going to use the same formula that we did earlier today. I hope you still remember the formula, which is going to be beta asset is what I want to find. Beta equity is what I'm going to put in here, multiplied by value of equity. So you're ungearing alpha. You must remember all the data that you're going to use is going to be purely from alpha. Alpha's equity, alpha's debt, alpha's tax. Sometimes the tax rate could be different, especially if it's in a foreign country. Okay, so this is going to be 120 plus 96 multiply with 1 minus 0.25. Have it a go, one shot. Just press your calculator, one shot, get the figure. You should get 1.68. What risk does it reflect here? What risk does it reflect here? Yes, do C and then I. No problem. Okay, very good. All of you are participating. All right, it's nice not to be alone. As I speak now, it's 1:40 in my country. Yeah, 1:40 a.m. Yeah, I hope it's okay with you guys in your country. Yeah, wherever you are. All right, 168. 168 is, anyone? What risk is it? What risk? Business risk of alpha. Yes, business risk. Sorry, sorry, I apologize. It's not 96. It's 96, right? Is it 96? 96. Yeah, it's 96. The debt is 96. Okay, debt is 96. We use 96 as your debt. Okay, Amartya is 96. Okay, not 19.2. Okay, because we are actually sorry, it's 19.2. Yeah, as I told you, it's already yeah, it's 19.2. Is that okay? 19.2. Apologies. Yeah, we have some auditors in the house. Okay, very good. So anyways, is it 1.68? Yeah, is it 1.68? What risk does it going to comprise of? It's going to be comprising of one risk only. Okay, I wait for your answer. Now, once you have that, you are already here. You are already here, and you just got 1.68. 1.68, you're ready to push this figure to TISA. So when you're going to push this figure to TISA, okay, you need some TISA guys coming in to pick up the figures. So what are we going to do? Just leave a line and go to the next step. Yeah, you don't have to explain so much. Is that okay? Just leave a line and go to the next step. You're going to re-gear to TISA. Now, when you re-gear to TISA, you're going to have value of equity, value of debt. TISA is 3.6. Check 10 million multiplied by 1.8 is going to be 18 million. So I need the total here because it's going to be value of equity plus value of debt. Okay, value of equity plus value of debt. So we're going to re-gear. Re-gear means loading of the financial risk of TISA. We're going to load the financial risk of TISA. Use back the same formula. 1.68 is what you know outside, which is a beta asset. We're going to multiply with, we're going to get that beta equity obtained in this manner, which is going to be all now will be TISA. Everything is going to belong to TISA, TISA debt, TISA tax. Everything is TISA. So you're going to get the answer here. I hope out of 100 students, one of them get this wrong. Get this first, plus 18. Take the figure, multiply together with all the 1.68, then divide by 1.18. If you're not sure about this, make sure then you better write the steps one by one. Get the total here, then you push it around. Okay, or you can remember another formula, which I think you don't have to remember so many formula. That formula rearranges for you the beta equity outside. But that is not given in your examiner formula sheet. So better use this formula. Beta equity, how much, anybody? It's going to be more than 1.68 or it's going to be less than 1.68. $1.93, Nikki. It should be more or it should be less. All right, I think it's not right. It should be more. Vasanta is correct. Yeah, it should be more. It should be 1.93 because it's going to be now representing the new business risk of component business risk plus financial risk of TISA. Okay, this is business risk. You add on. This is called loading. You're loading. Once you got that, what are you going to do? Once you got that, you're going to have a KE which is 3.5 plus 5.8 multiplied by 1.93. Yeah, you got a 1.93 over there, which is 14.7. Cost of debt 1 minus tax is actually given in your exam paper, which is 4.5%. So what is your risk adjusted WACC? Risk adjusted WACC is going to be, is simply going to be 14.7 multiplied by 18, which is your equity, and you're going to plus this with 4.5 multiply with what do you got there, 3.6, and you're going to divide this with the total. I think we got the total just now. You're going to get this. The only difference with risk adjusted WACC and existing WACC is this figure, 14.7. This 14.7 is you got from the beta of L4, borrow their component business and put it into TISA's gearing level to get 14.7. That is going to give us an answer of, I think, approximately around 13%, about around 13%. That's going to be the answer for this part A of the question. Okay, no problem. All right. Okay, no problem. Okay, 13% is good. Next, what we're going to do is we are going to some pages. Okay. The next is going to be process B, part B here. We're going to look at the testing us on, I think this question I chose just to show you the two businesses, getting rid of one of the business, taking only the risk that you want and re-gear to yourself. That's the idea of this question. There are a couple of questions here, can be tested for demerger, especially when you demerge something, when you sell off one of the business, then your asset changes, component of your asset will change, your beta will change. All this has been tested in business valuation topic previously. So here, very quickly, we're going to just probably I will just talk about VAR later. We're not just going to calculate, we're just going to talk quickly, okay? But let's do this very fast. Calculate the internal rate of return and the modified IRR, in this case of process omega. Given the IRR and MIRR for zeta is given, recommend which process you should choose to take. Okay, now I believe you can calculate a few things here, but before that, let's come up with some summary first. Summary. We're going to have MIRR. Okay, we're going to have IRR. They are already telling us for zeta 23.3, 26.6. Okay, omega is not given. Well, IRR, I believe you know how to find IRR. I'm just going to skip that part. Is that okay? I'm just going to skip that part. But of course, you need to do a process omega. You need to find some cash flows, especially for MIRR, you need the cost of capital. You need to find the present value of the return or recovery phase and the present value of the investment phase. So obviously, I think it's good to have a discounting done at the relevant cost of capital that you have obtained earlier. So this is going to be these are the cash flows that we're going to fit inside. These are the cash flows that we're going to fit in. This is going to be 3008, 1220, 1153, 1386, 3829, and you're going to get this figure here, 0, 1, 2, 3, 4. You're going to discount this at 13%. Now, to find IRR, many of them say 10 and 20. But if you take 10 and 20, that is not going to help you in finding MIRR. MIRR, you need to use a cost of capital, or in this case, risk-adjusted cost of capital. So why not you just take one rate as 13? That'll be good, isn't it? So that you just have to have one more rate to fill up your IRR. Now, this is going to give you a present value. This is 0.885. I leave that to you. This is going to be 3800, and your discount NPV here, NPV for this is going to be 1490. Okay, 1490. IRR, I leave it to you. Maybe I've done a calculation with me. I chose a 30%. Now 30%, obviously you can't see the table. You have to press your calculators to get 30%. Or if you really want to, you're so dependent on the table, you take 20%. Yeah, 20% will give you an NPV positive. It's okay. It's okay if both are positive, but so long as you demonstrate, you try to go for, you hunt for negative NPV by choosing a higher discount factor. 20%, I'm sorry, it's still negative. So I chose 30 and I got a negative of 208. So using in the IRR formula, I believe you're okay with IRR formula, you're going to get an answer of 27.9% if you choose 30 and 13. Okay, 30 and 13 is what you're going to get. But what I want to show you is MIRR. Now, MIRR, the formula is given in your formula sheet: present value of return phase, present value of investment phase, 1 into n, multiplied by 1 plus your WACC. In this case, it's going to be your risk-adjusted WACC. Careful, here your examiner puts in RE. In the formula sheet, it's actually return on entity. Is that okay? Return on entity, not return on equity. It's return on entity, or whatever cost of capital that you're using. If you are using for existing WACC, then you use existing WACC. In this case, we have to use risk-adjusted WACC. If in the event that this is going to be a PV question, ignoring financing effect, then you have to use KEI. Yeah, you have to use KEI in that case. Okay. Okay, now -1. So present value of I is going to be straightforward. It's 3800. Don't put negative and all that here, okay? Even though it's negative, don't put negative. And PVR is going to be the sum of all this at the cost of capital of 13%. I think you don't have to be adding this up. I think you add these two also, you can get the figure, which is going to be, how much is that? It's going to be 5290, and it's going to be 1 into 4, 1 plus 0.13 minus 1. Okay, so n is 4 years minus 1. There's a question here now. What if your tax is delayed by a year? Now, if your tax is delayed by a year, I believe it's okay to use 1/4. I believe it's okay to use 1/4, but an alternative way is you can also increase it to 1/5. Is that okay? If your tax is delayed by a year, your life extends 1 year, but it's only the tax part that extends. Very minor, very minor. So you may still continue to use 1/4. Put a note there, or just use 1/5. There was a question before. Your examiner used, not the current examiner, the previous examiner used 1/5. Okay, just to tell you. Okay, now, but so far our current examining team loves same year. So far he likes the same year, but there are one or two couple of instances. Yeah, I've heard students telling me the text is delayed. Yeah, the text is delayed. Well, one or two exams. Yeah, one or two exams only. Okay, so don't worry so much about that. So this is going to be, I hope you know how to press your calculators in this case. So it's going to be 22.7%. Yeah, that's going to be your modified internal rate of return. Okay. Wow. So a lot of questions here very quickly. Yeah, there's a lot of calculations, Emma. What to do, ACCA is like that. 8 marks, you have to slog for it. All right. Perfect. Okay. Yeah. Why PV of the return? Why not taking the sales of production at the end of year 4? PV of return phase, why not we are taking sales of production rights at the end of year 4? Well, in this question, we are going to have, these are the cash flows are given here. Yeah, these are the cash flows are given here. They didn't tell us what's the rights that you're going to get at the end of year 4. Probably is inside here. Yeah, they didn't tell us. You're going to sell it off at the end. Probably it's inside here. So that's included already. If they say separately, there's going to be some resale value or whatever. You just have to include that there. Okay. Paula, okay, you like my approach. Good. Okay. Briefly, the difference between IRR, yeah, I'm going to do that now. I'm just going to do that very quickly before we sign off. I don't think I have time for Emma. I'm sorry, I don't have the time for value at risk. Okay, now, so when you got this thing here, I'm just going to talk about the computation. So we're going to put back inside this figure here. We just calculated omega, which is going to be 22.7, and we got this 27.9. Now, if strictly decision making wise, if you strictly follow MIRR, by the way, MIRR or IRR simply means the return of the project. Is that okay? The return of the project. So if it is going to be 23.3, 22.7, well, obviously I'll go for zeta. It's giving me the higher IRR, but if I strictly follow IRR, it's going to be 27.9. Okay, 27.9. There you go. So this is going to be a conflicting decision, because this process is not this is not going to be it's not a different project, it's a process. It's going to be or zeta or omega. You're going to choose one. Conflicting decision. So this is what's going to be the problem of this MIRR. Now here we're just going to briefly say IRR assumes, yeah, IRR assumes that cash flows are reinvested at IRR rate. Okay, MIRR assumes that cash flows are reinvested. I hope I had time to explain all this, but you don't have to know so detailed in P4. F9, I think you have learned in detail. Yeah, just remember MIRR, cash flows are reinvested at companies' cost of capital. In this case, it's WACC. Now, NPV, on the other hand, which is a far superior method, assumes that cash flows are reinvested at companies' cost of capital. So there's consistency here with MIRR and NPV. And usually MIRR and NPV will give you the same results. Is that okay? It's going to give you the same results or the same output if you had the time. if you had the time, if you're not going to sleep later, you just go and calculate NPV. We know that omega was 1490. I was doing these calculations earlier when I was having a break. It was actually 1600. Okay, you calculate. If you calculate, you're not required to calculate. If you choose NPV, then NPV would have chosen beta. Can you see there is a consistency with MIRR and IRR? Okay, I think we'll take some questions before we sign off today. Tomorrow we have a session as well. Okay, what's the difference? I think we've done that. Okay, thanks. No problem, Emma. Maybe we have 2 minutes, Kishore. Yeah, just give me 2 minutes, Kishore. Kishore is our moderator. Yeah, we should thank him for being so helpful. Okay, now MIRR is going to be like this. I put it in a simple way. MIRR is going to be, I show you in a graphical manner. Picture tells 1,000 words. Okay, now in this question, there is a 1 year, you're going to see 1 year VAR and there's a 5 years VAR. Okay, let's forget about 1 year because in future exams, it's going to be tested on NPV. NPV is going to be for 5 years. Okay, let's take NPV for 5 years. We're getting some warning already. Yeah, okay. 1 more minute. 1 more minute to show. Thank you. Okay, so this is going to be, if you see this question here, if you see this question, don't worry about this annual. You take this as 5 years. Is that okay? You just multiply by 5. You're going to get here 11 million, and you're going to get the 99% confidence level, which means this is 50%. You can say with certainty 50% chance your NPV will be more than 11,000. But if you want 99% chance, then you have to sit here and look in front. You're going to stare at 99% in front of you. If you put your nose at the back, then you're going to stare 1% in at the back of you. But now we're going to stare in front. So this is going to be simply the VAR, where you need to use the formula Z normal distribution multiplied by standard deviation multiplied by square root of time. Take note of this. This is per annum, then only you multiply by time. If the question gives us this is standard deviation in total, then you don't multiply by time. Okay, I hope it's clear. So in this case, they gave us per annum, so you need to multiply by time, and this is 99%, but you need to look at the table for 49% reading, because this difference is called value at risk. Okay, 49%. If you read the table, I hope you can see the table. It's going to be 2.33, and your standard deviation, I think, is given as 800,000, and multiplied by 5 square root, you're going to get a value at risk of 1.4168,000 dollars. Is that okay? Something like that. Yeah, I hope Emma, this is the only thing I can help you today. All right, I think we'll take it some questions. All right, so I'll see you tomorrow. No problem. Tomorrow we'll be doing some multinational investment appraisal, or perhaps see, because we have Friday one more day, I don't want to keep everything to the last, or maybe we'll do some currency tomorrow, or maybe interest rates risk hedging, depends. Yeah, maybe we'll see tomorrow, or maybe Friday. Okay, all right, thank you, good night, have a good sleep, see you tomorrow, take care, signing off.